let's go ahead and do one more quick calculation before we call it a day. And we're going to calculate what would happen if we took this property back and had to do owner financing, or we chose to. Because owner financing can be a very powerful tool, especially if you end up acquiring properties for fairly cheap. We're going to say the present value, which would be the value that we would sell this on. If we're doing owner financing, we're not going to sell it for the lowest amount possible. We're probably going to sell it for the highest amount or close to it. So let's say we just sell it for $60,000. You know what? Actually, this is really powerful. We're not even going to do $60,000. We're just going to sell it for $50,000. Our term. Why don't we start with 10 years? Because if you can get out of the property in 10 years, it's going to be nice for you. It's going to help the velocity of your money move, keep that high and make you better returns. The other thing is generally 10-year notes, as long as they are sustainable, you have a pretty good job of selling those to other people that like to buy performing notes on the secondary market, and sometimes you can get a better price for that. There's this thing that's kind of often quoted called the 10-10-10 rule, which would be 10 years, 10%, 10% interest rate, 10% down payment. And so we're going to do 10 years, so that'd be 120 payments. Our interest rate is going to be 10%. We could use 9.9 to be safe, but most states should be good with 10%. All states should be good with 9.9%. Some states you can go above it. It just depends, but 10's pretty good. Future value will be 0, and let's calculate our payments. All right, so we calculate our payments here. It's going to be $660.75. That's actually not a bad payment at all, considering that area. If we were to rent out both sides, I believe the 2-bedroom side was going to rent for roughly this price, and then the 1-bedroom was going to rent for at least $500. So that's a very affordable payment for someone, especially for the area compared to rent. And that's a good metric you want to use if you're trying to plan on doing any type of owner financing, because if the payment's way out of whack to where it's much higher than rent, people may not be able to afford it, or they would just refuse it, because why would they pay so much higher than rent unless they just wanted to be have everything paid down very quickly. This would be our terms. So now let's calculate our yield. So the way we're going to calculate our yield for our note is we use basically the exact same numbers for the way that we structure the note, except the present value isn't going to be the same, because the present value that we want to use is the amount that we've had to put into the investment. We'll use our bids plus expenses, and you know what? Maybe there's some legal fees, especially for setting up this note. We want to make sure that maybe we get it professionally originated, whatever. We're going to go ahead and round our expenses up to $20,000. Maybe we had to put, a little carpet or something in it. In fact, you know what? Let's say we had to do a little work on the inside and everything. Why don't we just round everything up to $25,000, and we'll say that's what we're into it for when we finally sell it. The ink's dried on the paper, and we hand the keys to the new owners. Our present value changed, and now we can calculate our yield. So again, everything on this stays the same except the present value. Now we're going to calculate our annual rate, 30.092%. All right, so there it is. This is what our yield would be. It'd be roughly 30% if we owner finance the note, assuming that we had to sink a little bit more money into it. We couldn't get the best price for it. So is a 30% yield pretty dang good? Yeah, that's really good. Everyone should be ecstatic with a 30% yield on a performing note. That is incredible, and this is another vehicle that could really help you with some long-term wealth building. I'm not going to go too much further into it because this video is already getting long, but we've just calculated this if you kept it. We could do calculations where you keep it for a year, a couple years, and then you sell it and get a chunk of money for it. Since we're into a property for so cheap, it gives us so many options, whether we give them deed in lieu money, whether we give them a modification on the loan, whether we just outright sell it if we have to take the property back. We do owner financing. There's a theme to real estate investing, and that theme is You make your money when you buy. You buy right, you buy cheap, and that just gives you so much room to dig yourself out of a hole if you get in trouble. But anyways, I think that's enough for now. Hopefully I didn't blow too many minds. If you have any questions, don't hesitate to reach out to me. I'm more than happy to go over stuff with you. I'll be making some more videos in the future about calculations. Really, this is where you should be spending most of your time. This is what's going to make your money, make sure it's a good deal. Yes, it's nice to look at cute pictures of cute properties. This is a pretty good looking property in a nice, looking area. And, they're cute and everything, and that's good. But this is the important stuff. You need to drive by the property or have someone drive by, make sure that the property's not run down or in a bad area. But as long as that's good, the numbers are what make the deal. You got to do the numbers. You got to do your other due diligence. That's what'll keep you in business. We're not flipping homes. Notes. We're not generally selling sexy. That's not what we do. We don't go in and rip out a kitchen, put in something else, and post up a bunch of pictures. That's not our business model. This is the sexy stuff. So you need to learn it. And if you have any questions, don't hesitate to reach out to me. I hope you all have a good weekend and had a good week coming up. And take care.